Welcome to This Explainer. If you've been banging your head against the wall trying to find that one perfect, flawless technical setup, I promise you, you are not alone. Today, we're going to completely shift your perspective. We are going to move away from trying to be some sort of market psychic, and we'll dismantle those popular trading myths to build a highly reactive, rule-based toolkit for navigating the markets. It's time to embrace the liberating reality of becoming a highly disciplined, true trend follower.
All right, let's dive straight into this by confronting a question that trips up almost every single beginner who is out there desperately looking for a magical, guaranteed setup. What is the secret to a highly profitable trading strategy? Now, most people scrolling through online forums or watching gurus, they really think the secret is having this massive win rate. They kind of assume professional traders are basically fortune tellers who just never get it wrong. But the reality, drawn from actual professional track records, tells a completely different and, frankly, a much more liberating story.
Just take a look at this number right here, 43%. This represents the actual win rate of a highly profitable true trend follower. Think about what that actually means. It means successful traders literally lose more often than they win. Let that sink in for a second. More than half of this trader's trades are losers, 57% to be exact. This completely shatters the myth that you need to be right 90% of the time to make good money. The secret isn't in never losing. It's in how you handle those losses and, absolutely crucial, how you manage your winners.
So the absolute crux of the matter here is that predicting is honestly just a fool's game. Your edge in the market comes from reacting to market structure, meticulously managing risk, and using trailing stops to capture massive moves. The market is incredibly difficult to predict, right? It's filled with noise, stop hunts, random fluctuations. A true trend follower just accepts this. They don't try to predict that a resistance level will magically hold. They wait to see exactly how the market reacts to it, and then they make their move.
Here is our game plan for rebuilding your understanding of the markets today. Number 1. React, do not predict. 2. 3 types of trends. 3. Breakouts versus pullbacks. 4. Mastering multiple time frames. And number 5, the pre-flight trading checklist.
Section 1. React, do not predict. The myth of the perfect entry. Listen, taking a loss is simply a normal, everyday part of a reactive business model. When you stop trying to cap your wins with arbitrary take profits, and instead you just trail your stop loss right underneath key support levels, an amazing thing happens. A single trade can occasionally yield a massive 15-to-1 reward that covers all of your previous small losses combined. This is the exact math that makes a 43% win rate so incredibly profitable. By trailing your stop, just sliding it up right behind the price as the trend continues, your potential reward technically becomes unlimited. Now, yeah, getting stopped out at break-even or taking a small paper-cut loss can definitely be frustrating, but enduring that frustration, that is simply the price of admission for catching a monster, once-in-a-while trend that pays for everything. Moving right along to Section 2. 3 types of trends. Not all trends are created equal.
If you are going to follow the trend, you really need to know exactly what kind of environment you're dealing with, because treating every trend the exact same way is going to cost you money. You absolutely must categorize the environment by how price interacts with the 20 and 50 exponential moving averages. Think of it like this. A strong trend barely breathes. It hugs that 20 EMA with very shallow pullbacks. Now, a healthy trend, that's more rhythmic. It makes nice, clear, readable pullbacks right down into the 50 EMA zone or to previous support levels. And a weak trend, well, it's messy. It breaks right through that 50 EMA, which means you have to look for much deeper pullbacks at major long-term support and resistance zones. Pinpointing which of these 3 environments you're in is absolutely vital for what we're going to talk about next.
Section 3. Trading breakouts versus pullbacks. Choosing the optimal entry tactic.
Now that we know how to classify the trend, we need to know exactly how to enter the market without getting stopped out by just unnecessary noise. Your trend classification directly dictates your entry tactic. In a strong trend, you actually want to aggressively trade the breakout, because those shallow pullbacks will literally just leave you behind. But on the flip side, in healthy or weak trends, trading a breakout forces you to endure deep, painful retracements against your position. Think about it for a second. If a trend is healthy and it frequently pulls back to the 50 EMA, buying the breakout at the absolute top means you immediately have to sit through a massive drawdown as it reverts to the mean. It's incredibly painful, and it almost always leads to an emotional, premature exit. But in a strong trend, if you're sitting around waiting for that deep pullback, it's just never going to come. So you really have to adapt your entry to the specific behavior of the market that is right in front of you.
Section 4.
mastering multiple time frames, shrinking the risk, maximizing the reward.
Let's dive into a really cool advanced technique that professionals use to dramatically improve their risk-to-reward ratios. Once you have a handle on the trend and your entry style, you want to make sure your downside is locked in and protected. So instead of placing a massive, wide stop loss based on a daily chart, you can actually zoom into a 4-hour chart, wait for the sellers to lose control, and place a much tighter stop just below that new localized structure. For example, say the daily chart is in a healthy uptrend and pulling back to the 50 EMA. Don't just blindly buy it right there. Here is a massive pro tip. Drop down to the 4-hour chart. Watch for the market to stop making lower lows, and then wait for a structural break to the upside. By entering right there, your stop loss only needs to go below that recent 4-hour low, not way down at some massive daily swing low. This one simple technique takes a trade that maybe would have been a 1-to-1 reward to risk ratio and magically transforms it into a 3-to-1, or even better.
Finally, Section 5, the pre-flight trading checklist, removing emotion from the cockpit.
We are going to tie all of these ingredients together into a repeatable system right now. Because let's be real, knowing all this theory is totally useless if you don't have a disciplined way to actually execute it day in and day out. Just like a veteran pilot preparing for a cross-country flight, you need a procedural checklist to strip away your own emotional biases. Imagine a 60-year-old pilot with thousands of hours in the sky. They don't just jump in the seat and wing it, right? They use a checklist. Why? Because it completely removes human error. It removes the chemical and emotional imbalances of that specific day. You need to approach your trading desk with that exact same level of mechanical precision.
So here is the absolutely crucial takeaway for your daily routine, the 6-step cockpit checklist. Number 1, identify the condition. Ask yourself, are we bullish, bearish, or totally sideways? Number 2, the phase. You want to make sure you catch the market in a pullback, not chasing a run that's already exhausted. 3, draw your horizontal or angular support and resistance. Just map it out. 4, verify that we are dipping right into that 20 to 50 EMA value zone we talked about. 5, look for deceleration. Are the actual candles getting smaller as they hit that zone? Are they losing momentum? And finally, step 6, you wait for the trigger. Look for a clear candlestick pattern like a low test rejection or a doji. Here is the golden rule. Do not take the trade unless every single one of those boxes is checked. Period.
So, as we wrap up this explainer, I want you to ask yourself a very serious question. Are you finally prepared to accept a lower min rate in exchange for the ultimate freedom of rule-based trading? It's time to stop trying to predict the future. Start reacting to the actual structure in front of you and ruthlessly use your checklist. The next time you open up your charts, are you going to be a fortune teller or are you going to be a true trend follower? Thanks so much for joining me today, and hey, keep stacking those confluences.